In today's session, we'll be talking about all about the markets, how they've been this year, and of course, the major fear that is there out there about recession, and if and when are we seeing a recession going forward? How can we tailor our portfolio to sail through recession? And what has happened in the past whenever there's been a recession? So it would be everything about recession that you need to know in today's session. So, yes, let's quickly get started. So, this year, as we've all seen, so this is a snapshot of all the major indices in the markets, and this is as of 30th June 2022. And if you can see, almost most of the indices have been, in fact, every index over here has been in the red this year. We've had SPX 500, the benchmark index of United States, down 20%, NASDAQ 100 down almost 30% this year, and all the other European indices also. Germany is also down 20%. You have Surprisingly, you have UK 100, Canada, and Japan, which have not suffered as much as the other benchmark indices. So we'll be covering about this again in the future. I'll be talking about the reasons behind the same. But yes, like we can see, most of the markets, I mean, almost everywhere, we've seen deep losses. Even when it comes to some of the key stocks like Netflix this year, as of the first 6 months of the year was down 74%, Nvidia 58%, Apple 24%, Amazon 42%, Tesla 45%. So some of the key names out there were suffering major losses. Okay, someone has asked that will we be given a presentation copy for further review? Certainly, if you require, we can provide the same to you. You can always get in touch with your RM. But the entire webinar will also be uploaded on YouTube, so you can even have a look over there. You can get in touch with us, and we can provide the same to you. All right. So now, what has been the factor responsible? I'm sure all of you all are aware. The biggest problem in the room has been inflation, and like you can see across the globe, inflation has been a sign and cause of worry. We can also feel it over here in UAE. I'm sure fuel prices have gone up to the roof, and I'm sure each one of us have experienced that. So, like you can see, we have UK where the inflation is 9.4%. United States also was at 9.1%. Eurozone 8.6. We are at like a 4 decade high. This is the year on. I mean, the last 1 year, you can see how inflation has just gone up to the roof in United States and doesn't seem to be coming under control. So that has been the biggest problem this year, and because of that, we've seen central banks across the globe. They are adopting a hawkish monetary policy. In fact, sadly, but that's the only tool available with the central banks to control inflation. So the Federal Reserve has already gone up to like 150 basis points hike this year. And today we had the ECB, which also increased the interest rates by 50 basis points for the first time in 11 years. So yes, inflation, to control inflation, central banks have been increasing the interest rates. And because of that, of course, they would be indirectly killing the demand, because when interest rates are high, you're basically asking the consumers to spend less and save more, ultimately creating less demand. And when there is less demand, there are recession fears, like your growth will slow down, and hence we have recession fears. So so like I was saying, the US has been increasing the interest rates steadily this year. So this is basically the CME Fed Watch tool. I don't know how many of you know how to read this, but if I were to give you an explanation, so I just wanted to say that in case if you cannot see any slide, you can zoom in. On your mobile phones, you can just zoom in, or if you're seeing it on your iPads or your screens, there is an option on the right hand side which allows you to expand your screen, so you can just click on that button. Now, what this states is that there's a 95% probability that at the end of this year, that is December 2022, we'll see another 175 basis point hike by the Federal Reserve. When I say 175 basis points hike, that means another 1.75% hike. That's how you can read it. So now this information over here basically shows you that. Like you can see, there is a 27% chance that we'll see 27% probability that we are expecting the interest rate at 3.5% at the end of this year. There is a 38% chance that we are expecting the interest rate at 3.75% at the end of this year. And there's a 23% chance that we are expecting the interest rate at 4% at the end of this year, and obviously another 5% that we will see interest rates at 4.25% this year. So what you can say from this is that there's a minimum chance, like bearing this, like you can say there's a 93% in excluding this 6.8%, there's a 93% chance that at the end of this year we will be seeing interest rates at 3.5%. So a good part of this is that markets have already discounted significant amount of rate hikes this year. So that is definitely one of the good sides. But because of this, because of so many rate hikes that markets are foreseeing, they are obviously scared about recession. Now, what is recession? Recession is basically defined as two consecutive quarters of negative GDP. So when your growth is falling for two consecutive quarters, that is when we say that we are in recession. And since the World War II, there have been 13 recessions, with three of them happening just in this century itself. We saw 2001, 2008, and 2020. So, yes, the only exception to this was 2020, when we saw recession only for a period of 2 months. So, like I was saying, the definition for recession is that it has to last for a period of two consecutive quarters of negative GDP. But as we are all aware, 2020 was clearly one of the abnormal years and very different from what we've seen in the past. In fact, we've never come across something like this, wherein the entire world came to a standstill and growth dropped drastically and then rebounded also drastically. So, recession was considered only for a period of 2 months. Now, obviously, this year, many economists are expecting a recession. We've already had the first quarter witness a negative GDP in the US. So the growth fell by, I mean, not negative GDP, basically the growth, fell by 1.5%. So we are expecting going forward, if in fact, if this quarter also we see growth slow down, then technically we will be in recession. So obviously, it's a scary situation for the economy, because it will impact jobs, it will impact businesses. There will be slowdown. But what about the markets? Will markets also witness that kind of a slowdown, or how do markets react when there is a recession? So surprisingly, it's important, that the markets and the economy may not always be in sync with one another. There are times, I mean, markets are known to react well in advance. So most often than not, markets react well in advance. So, like we can see this year, markets have corrected significantly. Although when it was Jan and when it was Feb, even before the Russia-Ukraine crisis started, we didn't have any such signs of recession. But markets were already prepared for something like this. The talks of inflation had started well in advance, and because of that, since the start of this year. In fact, it has been one of the worst starts to any year since almost the last 2 decades. So markets have corrected significantly already, even before recession has started. And you may be surprised to look at this data. What you can see over here is that during recession, there has been, in fact, since, and this is for the last 13 recessions that we've seen since the World War II. So the average grade, the average returns in the markets has been like, in fact, a positive 1%. Very surprising. I mean, most of us would be expecting that the markets would significantly correct during recession. But like you can see that during the period of recession, 50% of the times the markets have ended up giving positive returns. So what it has been seen is that the correction generally happens like 6 months prior to recession. In fact, the index typically hits a high even 7 months before the start of a recession. So, and obviously the returns, if you invest during a recession or after a recession, the rewards are significant. As you can see, if you invest for the returns going forward for 1 year after recession has been an average 14%, and you have a decent probability of nearly 85%. For 3 years, the returns have been an average of 30%. For 5 years, we've had 57%, and for 10 years, it's been 150%. And just look at the probability over here. I think all of us know this, that in the long run, markets do end up giving favorable returns. And mind you, all of these numbers that I've stated over here, these do not even include the dividends that have been received. So these are the numbers even without any dividends. So if you add on that, the numbers would be a lot more. So well, yes. So what I was saying was that markets tend to react in advance. But of course, your next question would be: so does this mean the worst is over? We've already seen 6 months of fall. Uh, well, nobody can precisely predict that. Market turbulence has never been simple. But we need to understand that in the past, since the last 80 years, whenever there has been a bear market, the when I say bear market is that when an index falls by more than 20%, so from its highs. In the past, whenever there has been a bear market, the average equities have seen a decline of 35%. So for SPX, it was down by more than almost 23% or so from its highs. It was in bear market at one point in time. Now again, it's not in a bear market. It's recovered above 20%. But if you ask that. Uh, if you will ask, in fact, I mean, SPX has still a lot to recover, but yes, it has recovered significantly from the lows. But if you will ask that what has been the return during the last three recessions that we saw, so in the last three recessions since 2000, the average fall for the market was a mere 16%. Last 13 recessions, we saw over here, we had a gain of 1%. But if I take just the last three recessions, we saw an average loss of merely 16%. So SPX has already corrected way more than 16%. So you can never say if there is more losses left, but looking at what history has been, the losses in the past have been on an average 16%. So what do you do in such markets would be the next question. How do we play out during these markets? So before I answer to that question, let me just share this slide with you. So since obviously 2000, I said that there have been three recessions, but despite those three recessions, SPX has gained almost 300%. So and of course this includes the dividends. But in a duration when you have seen three recessions, despite that, the returns of having investor, I mean, the benefits of having staying invested in the long run have significantly outperformed the risk. So what this means is that obviously if you have your goals clear and if you have an investment from the long term perspective, then definitely it has its own benefits to remain invested in the markets in the long run, and probably even capitalize on these opportunities when there are dips. We start buying the dips, so it can turn out to be a pretty a decent strategy from a long term perspective. But if you are investing from a short term perspective, then definitely we need to dig in deeper and look out for different ideas out there. Now, the problem with when we are trying to understand that is there a recession, should we invest further, what do we do next, and should we withdraw if you're already invested? Should we withdraw our funds or should we enter now? The problem with all of this is that every time we try to time the markets, it is most likely than not going to be futile. It's very difficult to precisely time the markets. It's like if you say I want to invest here and then from there it has to go up, that's going to be very difficult. Or like if I sell here, then from there the markets should go down. It's very difficult to time the markets. Even experts have not always been able to do this. So and the problem is that when you try and time the markets, in the long run, in fact, it turns out to be more harmful. So the reason behind the same is that, so for example, this slide is basically showing you the 10 best days for the SPX 500 in the last 20 years. And it might just sound very surprising to all of you. Just look at it. The best days, when have they come? They like we've seen 11.6% returns on 13th October 2008. Would anybody in fact imagine that 2008 would be the year when you see 11.6% return for SPX 500? Like, it's a significant number. Then you have again 28 October 2008, again we have 10%. So the best returns seem to come when in fact it's one of the worst times that the economy is going through, or even for that matter the markets are going through. Now, the biggest problem is with timing the markets is that in case if you end up missing out, say just the 10 best days, if you miss out these 10 best days, your returns in the last 20 years would have like reduced by literally 75%. Yes, you heard me right, like almost 75% if you missed out on the 10 best days. Now, obviously, you'll not just miss out on the 10 best days, but my intention of telling and sharing this data with you is that in the process that we try and time the markets, we end up missing out, some of the significant gains, and then we regret missing out on that, and again enter into the markets, and probably we'll enter at the peak and then again suffer and sell at the bottom. This is a common cycle that happens when we are investing in markets. And one of the most relevant examples that I would like to share with you is that, so in the first on the first slide itself, I showed you how the markets have performed as on 30th June. So this was the half year return that we saw. And just in the last 20 days, you can see markets have rallied significantly. SPX is up 3%, Nasdaq is up almost 6%, Russell is up 5%. You have Germany, which is up 3%. You have Netherlands, which is up 12%. So most of the indices have rallied significantly, and it's not just indices. Even like, of course, stocks are a part of the indices. So Nvidia was minus 58 and Airbnb was minus 57% as of 1st July. And if I were to look at this data over here, you can see Nvidia is just down by 49%. That means it's gained nearly 9%. Airbnb is also up by 8 to 9%. You have Amazon again. This was down by 42%. If you can see over here, it's up now by like 7% from the lows. Apple has gained significantly. In fact, Apple even came out with a negative news stating that they would slow down their hiring next year. But despite that, the stock actually eventually ended up rallying. So from the lows, Apple is also up by 8%. And in the last 20 days, there has been no such information that has, come out, which is like actually been really favorable for the markets. In fact, we had inflation data which came out, which was worst than what was seen previously. It came in for US, it came in at 9.1%. In fact, markets previously even expected a 100 basis point hike by the Federal Reserve, which is now again come down to 75 basis points. But there was no such major positive news that came out in the markets for the markets to rally so much. So, what I'm trying to signify and imply over here is that always trying to time the markets is not been easy. And in the process, when we end up doing so, see, when you're trading, it's an entirely different thing. But when you are investing from a long term perspective, there should be a certain plan and certain strategy in mind that you should stick by when you're investing in markets. What happens is that when you try and time the markets, it basically ends up in I shall just show the slide to you 1 second. It basically ends up in this common investor behavior cycle, wherein you end up selling at the bottom, because obviously you feel that okay, markets have corrected significantly, it could crash further, this is, I'm going to lose out everything. And it is not just you, every person out there thinks like that's why the thing is, it's called as a common investor behavior cycle of fear and greed. So it's a very common thing out there which happens. And when markets do correct, I mean, do start rallying, then you feel that, oh my god, I sold at the wrong thing at the wrong time. It's going to rally much more. It's time to buy now. Let's buy in before it corrects further, and it rallies further, and I don't get a chance to buy later. And then when markets start falling again, we are basically in denial, and then again we end up selling at the rock bottom. So this is something, if you can avoid all of this, and if you can plan for all of this, if you can keep your emotions outside, then yes, trying to time the markets could be feasible. But we are all human beings, and it is not possible to precisely time the markets every single time. And which is why it is important to stick to a strategy to ensure that you can in fact capitalize on the dip in the markets in the long run. So the next question, okay, there's someone, someone out here who's asked that, so should we in fact start buying the tips? Yes. Okay, there cannot be a direct answer to this, but I would definitely recommend, when if you are investing from a long term perspective, if you have that horizon in your mind, and if you don't require the funds immediately, then certainly this could turn out to be the time when you should start investing, because we've seen in the long run it in fact pays out to invest during recession, because there's a lot of fear in the markets. And like Warren Buffett says, that whenever there's fear, that's the time you need to get greedy. But should you go all in? The answer to that would be a no. So we need to start investing in phases, and this is what we'll be covering in the slides ahead. Now, before I say that, obviously, I think one fear that most of you would be having in your, so yeah, I would, before just I'll just show you this slide again. So I was answering to this question that when you are investing from a long-term perspective, yes, it is very positive. So if you can see how this chart is depicting, that if you invest in SPX, say only for 1 year, your probability that you can make money is close to 73%, and there's a 27% chance that you can lose money. The longer you start investing for, the probability of losing out starts falling steadily. So from 27%, it will directly dip to 19% if you stay invested for 2 years. Dips further to 16% if you're invested for 3 years. Moving on quickly, it will fall down to literally 9% if you're invested for 7 years, and literally fall down to 0% if you're invested for 14 years. And this includes any rolling 14-year period since the inception of SPX. So, say if you invested in the year 20 in the year 1925, 1945, 1950, 1970, 1990, all these years, whenever you invested, if you invested for 14 years, there was no way that you would have lost money. Historically, this is what the data is saying. And again, these numbers do not include dividends. So with dividends, the numbers would be much better. And also, even see, even if you're investing for 5 years or 10 years, if there is a probability that you can lose money, but whenever there's a dip, certainly you would average. And if you average when there is a fall, in fact, even in 5 years timeline, you would in fact end up making money. So there is the probability of losing out money when you're investing from a long-term perspective in S&P 500 has been really low. So now, of course, I'm sure this has been a lot of positive data, but coming to the key question, this year has been one of the worst years to, one of the worst starts to the MSCI World Index, to S&P 500. Markets have corrected significantly in the first half of the year, and that is obviously raised a lot of fear for everyone out there, that what do we expect for the latter half of the year. Now, before I share that information, I'd just like to show you some of the stats, that what has happened in the past whenever SPX is corrected significantly from the highs. So whenever the SPX 500 is down by more than 15%, what has been the returns for the markets in the latter half of the year. So just look at this data over here. We had 1932, 1939, 1940, 1970, and of course this year we've seen massive falls wherein the index has corrected by more than 15%. Now, when such a time comes, you actually feel that okay, the latter half is going to be even worse, and we could see further downfall and further correction. But just look at these returns. There has been no period when the market has been negative for the latter half of the year. In fact, the average returns has been 23%, 24. The lowest has been like 6%, and the maximum has been 56%. So uh, bad starts don't necessarily mean that there is more trouble ahead. But of course, you cannot ignore the fact that there has been significant amount of rate hikes. There will be definitely a slowdown in the economy. But like I was saying, when it comes to markets, not necessarily the market and the economy may be in sync with one another. So yeah, you can also see this. Our previous quarter was also really bad. This was again one of the quarters we witnessed more than 15% fall. And whenever we've witnessed this in the past, this includes data from 1950 onwards, whenever this has happened, the quarter that follows, we've had an average return of 6.8%, with only one quarter giving negative percent. But in the long run, like 4 quarters, 1 year down the line, the average return has been 30%, and obviously it's been 100% probability, and there has been no negative return in the 1 year period following a quarter which has seen a 15% fall. So now coming to the key question, how do we do, what do we do in these markets? How do we invest in these markets so that we do not fall into the trap that we saw of, uh, so that we do not fall into the trap of, the fear and greed cycle that we just discussed. Okay. Okay, there is a question by someone that how do you compare an individual stock investment with a mutual fund? This is an amazing question. So you need to understand that when we are investing with mutual funds, it's obviously a fund which is investing in probably 10, 20 different stocks and not just in a single company. So that is something we would be covering in the slides ahead. It's very important that there's a very common, in fact it's there on this slide itself. It talks about all eggs should not be invested in one basket. So when you invest in just one particular stock, for example this year, I mean last year, if you would have, in fact this year, if you would have invested in Netflix, the start of the year till the mid year, you would have seen the stock crash by literally over 70%. um, so that, and Netflix is one of the good companies out there. So yeah, you don't always predict and foresee that what could go wrong. So Netflix obviously started facing a lot of competition out there, because of which the stock fell miserably. And obviously 2020 and 2021 was a year when we had a lot of lockdowns. So Netflix did see a lot of growth in its business, which is now started to shrink. And of course, competition has been another issue for Netflix. So, if all your money was invested only in one particular stock, you would have lost significantly. But if we would have invested in a basket of stocks or in a mutual fund, which is investing not only in one particular stock or in one index, but across different indices, then the loss becomes much lesser. So yes. What is the best FM would stand for, like financial markets for beginners to invest in? Am I getting you right? Like, what are the best markets for investors to for beginners to invest in? Certainly, one of the best markets, if you are a beginner, would be the US markets. In fact, it would be like the global markets when you're investing in. So if you compare, for example. I'm giving this presentation on I have a Microsoft system over here. I'm using Windows. We are probably some of you are watching this presentation on your iPhone or your Mac. We are probably paying for our bills through a Visa or Mastercard. We are everything out there that we are dealing with. I spoke about Netflix. So many things. The kind of clothes that you're wearing, probably you're wearing a Zara, or even um, if you prefer a Michael Kors or LVMH. All of these are global brands. And if we are investing in all of these brands, if you're using a Google, for example, every time we need something, all we do is just quickly go to Google. If you want to watch some videos or something, probably you switch to YouTube. If you want to shop something, we are going on Amazon. All of these names, most of these are from the US markets. And in fact, if we ourselves, are using these products to such a great extent, if you have a social media account on probably Instagram, we are using all of this to such a great extent. So why not invest in these companies? In fact, these are global companies, and US is definitely one of the strongest and the largest markets out there. So in fact, when a United States, when the US markets witness a fall, even if the other countries are doing really well, most likely we see that they also tend to follow, because it is obviously US is the superpower. So if you are a beginner and you want to start investing, certainly one of the best markets to start investing would be the US markets. I hope that answers your question, because majority of the strong global brands are from the United States, and which is why it makes logical sense to invest in the US markets. Also, another strong reason why it makes sense to invest in the United States is because, of course, it is the leading global. Um, um, the leading global market out there, and obviously the country also, it is a superpower. So what happens is that this year, for example, we've seen significant crisis out there. Markets have corrected significantly. You have the Russia-Ukraine war, so dollar ends up being the strongest currency. So that is where also that you end up making a lot of returns. So obviously this year, when I shared the data, yes, US has corrected significantly. We've seen falls of 16% year to date in US compared to Germany, for example. Okay, it's also lost 16%, but Netherlands, for example, has lost only 12%. But US, you will say, has lost more than uh, Netherlands. But it's important, or for that matter, even France 40 has lost less than what the United States has lost this year. But when you consider the returns on a net basis, considering the currency effect, this year the dollar has gained almost 10% against the euro. So if you consider that net net, your buying power, your purchasing power has also gone up because of dollar. So dollar has gotten stronger by 10%. So obviously that your purchasing power increases. So if you consider the net effect, in fact, US could have still outperformed many markets this year. But of course, like I was saying, from a long term perspective, or the best way to invest when you're investing in markets, it is obviously we need to make a diversified portfolio which is catering to all of these markets. So if you would have invested only in the United States, we would have lost probably 23%. But in Nasdaq 100, we would have lost 23%. But if you would have invested in the entire basket of these indices this year, then your loss would have been just 12%. So diversification really helps in the long run. I hope I've answered to those questions. But in case if you have more questions, or if you want another detailed one-on-one session, we can also do that. You can always, in fact, even come to our office. That is also welcome. You can get in touch with your RM and schedule a one-on-one discussion with me. We are always there to help and provide maximum service possible. So the whole idea and goal is to create maximum financial awareness, and I'm glad that you all are asking these questions. So, yes, so we were discussing then what do we do and how do we invest in markets like these. So, firstly, to ensure that we are not resorting to any kind of panic selling, make sure that you have an emergency fund for at least 6 months of living expenses. Obviously, when there is recession and any kind of recession fears, it does lead to a significant amount of fears about you losing your job or the economy not doing well, because of which the business suffering. So keeping all of those things in mind, to ensure that you're not taking any emotional decisions with regards to your portfolio, at least 6 to 7 months of funds kept aside to ensure that you can live easily for 6 7 months without any hassles. um, okay, you were asking for platforms about okay, S&P, eToro, or all right. Okay, when you're asking about such platforms, which platform to invest in, I would just like to say that whenever you're investing with any kind of platform, just make sure that the company has a significant backing. Like in our case, we have CMC backing us, so just ensure that. Whichever company that you're investing through, the year is obviously been bad for many companies out there because markets have corrected significantly this year. So just ensure that whichever company you're investing your funds are safe, and they are protected and guaranteed. Just look at the track record and the history for any company. For example, we've been in the UAE markets for over 30 years now, so that gives you a significant amount of backing and safety net. So when you're investing, just be careful about where you're investing. There are many providers out there. You just do your research and decide where you want to invest. But when you're investing with Century Financial, there is definitely, we provide you with. We have our team of consultants out here, so you will be allocated your personal consultant, or with whom you can have multiple discussions before you decide to take any trades. So yeah, when you take those decisions, just be wise enough, do your research, and accordingly start investing. So moving forward, yes, we also spoke about. So when you're investing, it's important to ensure that the kind of portfolio you have caters to your risk profile. So so basically, okay, I'll just finish on to the slide and read on to the next questions that we have out here. Now, when it comes to when you're investing in markets, it's important that your portfolio is reflecting your risk profile. So, say for example, a client is, or you for that matter, are risk averse and do not want to tolerate much movement in your portfolio, and you cannot witness a 15% fall in your portfolio in a single day. Then investing in a volatile stock, for example a growth stock or stocks with high beta such as say Shopify, it would be a very risky bet. Like growth stocks are something that move significantly in a single day. So if you cannot foresee that, and if you panic sell at the bottom, then obviously it's not good for you. So when we are investing in markets, it's necessary to ensure that your portfolios reflect your risk tolerance, and you need to stick to a plan which definitely allows you to invest in the long run and not sell out at the wrong time. Of course, like I said, it makes more sense to opt for exchange traded funds or index funds, because when you're investing in an index rather than one particular stock, your chances of losses minimize, because an index is investing in multiple stocks at the same time. So you have exposure to many stocks at the same time, and you're not restricted to one single company. Also, during recession, defensive stocks such as you have consumer staples, you have healthcare, these companies end up doing much better, because even if there is a slowdown or if there is a recession, the business for these companies cannot see a major hit. You can't stop going for your grocery shopping or your normal healthcare during a recession as well. So these companies, you have Coca-Cola, you have Johnson and Johnson, stocks like these end up doing well even if there is a slowdown. So when you're investing in these in during these times, it's important that you stick to quality names with sound balance sheets, that even if they witness a slowdown, even if the stock falls in one particular year, they can easily recover in the years going forward, because obviously they have strong balance sheets and the ability to withstand any slowdown in the economy. And most importantly, we will be covering this in the slides going forward. It is very important that you stick to something known as dollar cost averaging. That is, don't invest all at once. Make a plan, invest probably every month, every 15 days, or every week, slow and steady. Invest in the markets. Now, that brings me to an important slide. Now, we'll look at this later, but yes. Let me quickly start a poll which talks about, I just want you to take a guess that if $1,000 an SIP is basically a systematic investment plan, that is, you invest say $1,000 in the SPX 500 every year. So if you started doing this since the year 1988, um, I want you to take this poll and let me know what, according to you, would have your portfolio value grown to as of today's date. $1,000 in S&P 500. How much do you think it would have grown to as of today's date? Let me tell you, your investments would have been close to $400,000. All right, amazing. We have many over here who think the portfolio would have grown to as much as $2.2 million by now. Wouldn't that be amazing? Just sticking to a basic hassle-free approach and making $2.2 million. There's someone who thinks it would be 1.5. There are even some who believe it would be $3 million. So I would just wait for another 5 seconds, 5 to 10 seconds before I end this poll. All right. So, okay, we have the the results. Many of you believe that the value would have grown to 2.2 million, which is definitely amazing. But the actual answer is it would be almost 3.2 million. So, if you invested $1,000 in the S&P 500 every year, starting every month starting from 1988, it would have actually grown to $3.15 million dollars. Isn't that significant? Like from 1992, in just a span of 4 years, if you just miss out those 4 years, it would have dropped to almost $2 million. And in the last 10 years, also, the returns have been like you would have easily doubled your money just by investing in a fixed way in the S&P 500 every month without doing anything. No stress, no hassle. Just stick to this methodology, and you could have made almost 95% returns. Like you would have just doubled your money in a span of 10 years. I skipped this slide. Now, it's very important that when you're investing in such markets wherein there are recession fears and we don't know to what extent the markets could probably witness further fall, or probably is the bottom already in, then in such cases, it's very important that you stick to minimum leverage, or in fact avoid using leverage. Uh, because what happens is that when you're taking leverage, obviously your profits can magnify, but at the same time your losses can also magnify. So when investing in markets, especially during recession, it's important to avoid using leverage, much leverage. Now, another strategy that you can stick to or follow, and we've actually rolled out this portfolio already. Your RMs can show this to you. But one very important way and strategy that you can invest in markets is through a ladder portfolio allocation. Now, what this talks about is that we invest in phases. Now, in the first phase, we look out for 25%. In the second phase, when markets correct, say by 10%, you go in another 35%. And say when the markets correct further, you go in for another 40%. So, what happens like this is that one, you get to capitalize on the dips, and two, if I mean, you are not invested all in one go. So say if markets start running, obviously you've invested some, so you are participating in the markets. But if markets correct further, you have the opportunity to capitalize on those dips and better your average. Because like we've seen in the long run, everybody, when you see markets are falling and crashing, it just gives you that impression that, oh, this is probably the end of it all. But it isn't been like this. You just go back to your history and look at SPX 500 for any number of years. It has always eventually in the long run outperformed. So investments in phases will definitely be a great idea. Now, the portfolio that we've made to is it basically caters to aggressive, moderate, and conservative stocks. When I say aggressive stocks, these are stocks which have a beta of more than one. That means if markets move by 10%, these stocks will move up by more than 10%. Moderate stocks tend to move in line with the markets, and conservative stocks tend to move less than your S&P 500. So now, obviously, if we have recession fears, I spoke to you about some defensive stocks also. So stocks like Coca-Cola, you have Dollar Tree, Johnson and Johnson, Kroger. They can help you. They can help you withstand any major correction in the markets. These companies may not witness as much as correction as the other stocks. Meanwhile, you have certain stocks which may move in line with the markets, and then you obviously have some technology companies which end up being more volatile than your other safe stocks. So, what happens when we stick to this ladder approach? In the first phase, we'll be investing. Say, if you have a $1 million portfolio, in the first phase, you go in only for 250,000. In the second phase, we increase further, and in the third phase, we go all in. Now, also in the third phase, when obviously there has already been a lot of correction in the markets, we focus less on conservative stocks, and at that time, we start increasing our exposure to technology or aggressive stocks, because that is probably the time when these companies have fallen a lot more, and it is time for them to rebound higher. So, this is a ladder portfolio that was prepared for blue chip stocks. We also have a ladder portfolio for indices. So I covered all of those indices in the slides earlier. This year, like I showed, in fact, when all the other indices have corrected significantly, the FTSE, that is the UK 100, has actually gained 0.4%, considering all your dividends and everything. Isn't that significant? Like, I mean, in a year where almost every other index has witnessed, significant amount of correction. Now, the reason why this has happened is because almost 35% of UK 100 belongs to, consumer staples or healthcare stocks, which is why this year it has been positive for UK 100. So, if you don't want to stick to, if you don't want to follow an approach wherein you have to handpick a few stocks and you just want to play it safe and without any tension, if you want to invest, you can probably diversify your investments across different indices. And again, in indices, also don't go all in, and you can look at a um, ladder portfolio wherein in the first phase you invest say 20%, in the second phase you go for another 35%, and then 45% in the last phase. So this gives you an opportunity to capture the dips as well. Now, this is what you can stick to. But like I said, it's very important that you get in touch with your respective RMs, and on those basis, we can cater to a one-on-one, a decision. Um, all right. Okay. There's someone who's asked me, who's told me to contact them for an SIP investment in dollar basis. Certainly, I will ask your RM to get in touch with you, and then we can stick to this plan and move forward with an SIP based investment going forward. Now, these were some ideas that you can stick to, but something that we do, which is not very common out there in the markets. Okay, now before I show you that slide, this is how your portfolio can look like. We can cater to like 50% in blue chip ladder portfolio and index portfolio. Now, out of this 50%, also you have to understand. Only approximately 20 to 25% will go upfront in the first phase. The remaining will be left as cash, and only when there's a correction or a dip in the markets, we'll invest further. Of course, we need to analyze the situation over time and see how things are moving forward. But in the first phase, you would be investing only 20 to 25%. So you can say almost 40% would stay not invested in the markets. Now, another 20% could be invested in a municipal and investment grade bonds portfolio. We've already prepared a municipal bond portfolio. So, in case if you're interested in the same, again, please get in touch with me or your RMs, and they can provide you with the same portfolio. Now, apart from that, now 15% can go in for market neutral strategies. I will talk about what market neutral strategies are in the next few minutes. Then we can have 10%, which would be invested. I spoke about defensive stocks. These are stocks which tend to do well even if we are facing recession. We can invest 10% in defensive stocks, or even look out for a dollar, or just hold those that much cash, because like I said, dollar has been the king this year. It has gained almost 10% against other currencies. So just holding some cash as or investing in dollar would have been beneficial as well. And of course, some amount, a significant percentage, like this year, gold has fallen almost 8%, because gold does not pay any interest. And when interest rates go up, gold does witness a fall. But still, gold is considered as a safe haven asset. And in case if there is any major correction that we come across in the markets, at that point in time, gold turns out to act as a safe haven and benefit your portfolio. So a small allocation around 5% would be advisable even towards gold. Now, I spoke about market neutral strategies. So, what are market neutral strategies? Market neutral strategies, basically, it is basically about investing in the markets in a way that even if even if markets go up or down, your portfolio is neutral to the market. So what it means is that it is basically a pair strategy between two instruments. Okay, now these two instruments are generally correlated with each other. So whatever happens in the markets, they will most likely be impacted in the same way. Both will go up at the same time. Both will most likely go down at the same time, because they are correlated. Now, the idea is that no matter what happens to the markets, we are just capitalizing on the movement between these two instruments, and we tend to profit from the movement between these two instruments, and not with what is happening in the markets. So I will just take an, I mean, I've done an entire webinar on this. And if you're interested, we can again do a webinar on this session. This video is already available on YouTube if you're interested. But if I were to explain just one of these for your reference, it would just help you understand better what am I talking about. So let's start with Brent and WTI. Now, Brent and WTI are two categories of oil. Both are oil. So obviously, when the economy is going from recession, both these commodities will fall. When the economy is doing well, most likely both these commodities will rise. So what we try and capitalize on is the spread between these two commodities. So say historically, on an average, we have seen that the spread between Brent and WTI. When I say spread, it means the difference between Brent and WTI. Now, say the difference between Brent and WTI has been on an average like 5%. So, this is the difference between Brent and WTI. Now, say the difference increases drastically to 10. Now, this gives you an opportunity because the average difference has been 5. So what will happen is that obviously one has gone up and the other hasn't. So since both are different grades of oil, obviously if one is available at a much cheaper price, people will start buying this one, and the price for this one will go up, and automatically the demand for this will come down. So the price of this one will start falling. Now that is what we try to capitalize on. We'll sell the one which is rallied significantly, and we'll buy the one which is not rallied. In the process, when both of them come close to each other, we'll end up making money. Or for example, now, Brent and WTI, I said, for example, the average has been $5 to $6, the spread, the difference between two. In case if the difference falls significantly, generally Brent trades at a premium to WTI. Now, if the difference, for example, if Brent is trading at, say, 100, okay, and WTI is trading at 95. So generally, the difference has been this much. Now assume that Brent comes down to 95 and WTI is also trading at 95. So what will happen is that there is a possibility that going forward, Brent will rally more than WTI. So this gives you an opportunity to capitalize on the same. What is the YouTube name for the webinars recorded? You can just go to Century Financial, go to Century Financial's website, and out there you can go onto the videos and look out for different sessions out there. For this, it is strategies for volatile markets. There you can get all about market neutral strategies. I hope I've answered that. Just go to Century Financial, search for Century Financial on YouTube. Out there, you will come across the videos uploaded by Century Financial, and you can search for investment strategies for volatile markets. It was just covered last month itself, but I will be doing another session again because generally it interests a lot of users. So, if I were to give you an example, I'll just share my screen. Just look at this flyer over here. It was released on 13th May 2022. If you can see, according to this trade, the spread between Brent and WTI was close to, according to this, you can see over here, it was at 2.2. That means Brent was trading at 103 while WTI was trading at 101. Now, what we were expecting was that this difference of 2.2 could increase further, and if it increases further, it would result in profits because you would end up buying Brent and selling WTI because 2 is way below the historical average. Now, if I were to show you the chart again as to what happened when we were in the last 2 months, this is the spread of Brent and WTI. So the like I said, the flyer was released on May 11th. Since then, Brent actually, the difference between Brent and WTI, it actually increased to almost 9.5 before before currently coming down back to 3.86. So from 2.2, the spread that I showed you, it went up actually to 9.5. And again, if you were to see this slide, just a second, I'll just share the screen again. Yes, so if you can see, if we entered at 2.2 and it went up to 4.5, the trade would have resulted in a profit of $11,500. Obviously, if your exposure is 500,000 on each side, assuming almost just two times leverage. And if it went up to 6.5, the profits would have been $21,500, which is in percentage terms, it would have been 4.3%, which is on an annualized basis, it is 15% returns. So you're making 4.3% in a span of almost less than 2 months. Because obviously 6.5, the high that we saw was 9.5. So the second target over here was also achieved. And the spread actually went up to 9.5, like I showed you. Over here, when it was given, it was close to 2. And that's when it rallied and it went up to to almost 9.5 before correcting again to 3.6. So, generally, historically, we've seen this trade ends up providing, like, the lowest that it has gone is negative 0.68. So, in this case, your losses are limited from 2.2. You keep a stop loss at minus 0.68 and capitalize and target for the upside. Likewise, when the spread is 9.5, this also gives you an opportunity to enter the trade, but this time it would be an opposite entry. So these are the kind of trades that can be taken. Another trade that could probably end up, if we believe that recession is coming, and something that could end up doing well if the economy does slow down, would be if you go long on gold and short copper. Now, so see, try and understand, both gold and copper do not pay any interest. Both gold and copper are dollar denominated instruments. Of course, they do not move and they're not highly correlated, and they do not move, according to the economy at the same time. In fact, they end up moving inversely. What will happen is that copper is something that does really well when the economy is doing well. So when the economy does well, copper ends up going up. When economy does not do well, copper will start falling. Gold, on the other hand, is considered as a safe haven asset. So when the economy is not doing well, or when there's a lot of recession or such fears, gold ends up doing decently well. Now, maybe gold does not go up this year, but what we are expecting is that gold will outperform copper if there is a recession. So what happens is that if you go long on gold and short copper, even if gold is constant, but if copper prices fall, the trade ends up making a lot of, profit. So that is what we are looking at. Likewise, we also have something called as long SPX, short DAX. Now, if there is recession and you do not want to take the risk of investing in markets all at once. So, for example, you invest only in the S&P 500, and if the S&P 500 corrects significantly, then you end up losing out a lot. But at the same time, if you end up selling another index, I hope you all are aware as to what shorting or, how can you short sell in the markets. But if you end up buying one index and shorting another index, so if both the indices, for example, if there is a correction in the markets and markets witness further a downfall, so on long SPX, if that is giving you losses because you've sold this index, this will also come down, but this will give you profits. So net, your losses will be much lesser. For all of you who are not aware about what short selling is, I can definitely take a one-on-one session, or even just do an entire session again on market neutral strategies, and we can cover this in the next session once again, because we've slightly overshot today's session, and I'm sorry about that. But you guys have been a wonderful audience. So, yes, so this strategy is basically we are going long on the S&P 500 and selling DAX. Now, what are we expecting out here? We are not saying that S&P 500 will rally and DAX will fall. What we are saying is that what we are expecting is that the S&P 500 in the long run will outperform the German index. Now, what is the logic behind this trade? See, firstly, this year, the Eurozone, in fact, has been the last to increase the interest rates. S&P 500, the United States has already increased the interest rates by 150 basis points this year. In fact, they have another 75 basis points, which will happen in most likely in just another 5 days. So, the interest rate hike has already started much quicker and faster for the United States, and in fact, they have already priced in. We saw already they've already priced in almost another 175 basis points hike for the end of the year. The same cannot be said for the Eurozone. Secondly, because of the Russia-Ukraine issues that we've seen, obviously the gas they have started increase providing 40% and natural gas now to the Eurozone, but still it is way below what they were receiving previously, and they're not out of those prices yet. So the situation is all the more worse for the Eurozone than it is for the S&P 500. And even if the situation starts correcting, in fact, the United States would in fact end up benefiting more, because if oil prices come down, it is all the more beneficial for the United States, because inflation will start coming under control, and automatically things could turn out being much better, because like I said previously also, the US is one of the stronger markets out there. It is the superpower, so its tendency to outperform the other markets in the long run also increases. And the whole idea behind this trade, because it's a recession proof idea, the whole point is that in case if markets witness a further correction, because you're taking a pair trade, the probability of the loss decreases. It is obviously, you cannot say that okay, it is a trade where there will be no losses at all. No, it's just that your chances of losses and the amount of loss reduces compared to a naked single position. Of course, it could be an entirely reverse way wherein SPX keeps falling and DAX keeps rising. So in that situation, your losses can in fact magnify. But these are some calculated risk. Markets are all about taking calculated risk, and these are strategies that we have prepared, and it's important to ensure that stop losses are always taken when you enter into trades like these. And whenever we take such market neutral trades, obviously there are a lot of statistical analysis such as the standard deviation, z score, and various other factors that go into play when these trades are devised. So yes, that is it for today's session. We spoke about many ideas wherein uh, yes, we spoke about many ideas as to how we can plan for a recession based environment. There's also something called as a Swiss row portfolio flyer, which again I've covered in the previous sessions. If you're interested, we can do a one-on-one session or another session for this. But overall, your portfolio could look like something like this. And I said this is not a one-on-one advice. We have to ensure and cater your plan depending upon your investment goals, your investment duration, your risk profile. Everything has to be considered, and accordingly, a portfolio has to be devised. But this is something in general that can be referred to. Most importantly, a dollar cost averaging or a systematic investment plan is something that should be considered when investing in markets. So I'm sorry for extending today's session. In case if you have any more questions, I'm here to answer, or else if not, we'll wrap up this session for today. I hope you found it informative and interesting. Just looking forward for for you joining us at another session as well. And yes, so thank you for being an amazing audience.